macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Did the stock market get ahead of itself, and how vulnerable is it to a correction? These are the questions I'm trying to answer this week, or at least I'm asking. Ever since May 22nd, about 2 weeks ago, where we began the taper talk question, this market has been vulnerable, and we're getting the pullback now. It's in full swing. Let's take a look at some charts to see where we're at. All right, this is the Spiders 6-month daily chart with 50 and 200 week moving averages. I skipped the volume today, and I'm just showing you the MACD on all the charts because I just want to show you how well it picked this top and gave you a short signal, for a lot of folks who rely on the MACD indicator. All right, up top, I've got a green line drawn here at 160 on the Spiders, and this is a level that I've been concentrating on just as I thought it would be a magnet for the market to go down there up to the FOMC, path of least resistance lower. All right, let's look at the other levels. Red line here at 156, about 1560. Why? Because that's sort of the top center of a big consolidation zone that we had in March and April between 1540 and 1560. That would be really the next support if we fall through 1600. Now, I'm showing you this Spiders right here above 162 or 1620. This morning while I took these charts, I made these charts within the first hour, and since then we've dipped below. We've seen 1615 on the S&P. All right, next line I have drawn is at 1520, 152 on the Spiders. That would be another strong area of support, and if we worked our way down to there, we'd be meeting up with the 200-day moving average, which could take another 6 weeks, maybe 2 months if that happened. Volume-wise, I just want to mention, though, even though I'm not showing the volume, the 90-day average volume for the Spiders has been 128 million shares, but the 10-day average is up to 161. So you're seeing the volume increase as the ranges get bigger. There's more distribution and more selling. All right, let's take a look at the IWM next. And I've got a line drawn here at 950. It's a level I've been talking about. Could we come back and test this prior top? 50-day moving average comes right in there. This has actually been one of the stronger indexes. Where would we go, in a more extreme correction? Well, down to 900 on the Russell 2000, below 90 on the IWM. 200-day moving average will come up to meet there. And last week I talked about the 870 level on the Russell 2000. 870 being the prior double top that we hit in 2011 in the spring and then in 2012. So that should be an area of strong support for the Russell 2000. So just think about 870, but there's going to be plenty of buyers around the 900 level. All right, next let's look at the Qs. Triple Qs here. And I've drawn a line at just above 71 because this market will probably fill this gap. 50-day moving average right below there. And then I've drawn a line at this congestion top here, about 69. And remember, this was a level that was roughly equates to about the 50% retracement of the big move from 2000 to 2002 in the NASDAQ 100. And so 69 is about a 50% retracement of that. That's why it was a key breakout level for the NASDAQ and tech stocks. Again, MACD there showing up, giving a buy signal to a lot of folks. All right, next I want to show you a very unique chart. Let me explain it first a little bit. We're going to compare the sectors, but we're going to look at their breadth, what we call sector breadth. And one way of doing that is just to show the percentage of stocks over a certain moving average. In this case, I borrowed a chart from a trader friend of mine who he uses the 150-day moving average. What percentage of stocks are over the 150-day moving average? And then he puts all the sectors together in a graph, also shown with the NYSE composite here. So you can see, now this was taken 2 weeks ago actually. We haven't updated this yet, but you can see how 2 weeks ago it showed, we were in the overbought zone. He writes greed up here because, over 70% of stocks in a given sector over their 150-day moving average is overbought, and he calls that the greed zone. So you got financials up here between 80 and 90%, consumer discretionary between 70 and 80, industrials between 70 and 80% over their 150-day moving average, consumer staples between 80 and 90%, materials way down here bringing up the rear, but you're not even seeing where the oversold zone is below 30%. So you can see by many measures how much optimism was built into this market and how vulnerable that made it to a correction, which we're in the middle of. You know, how far it goes, does it need to be the 6% correction, or are we going to go all the way to the 10% correction? All right, you know, so that's the big question. Now let's look at why I still think we're going to see new highs this year. All right, with odds of 2 out of 3 chances here. So number one, the economy. No recession coming. You know, we're steady as she goes, GDP of 2 to 3% growth, even as QE slowly fades and rates crawl higher. Now let's talk about earnings. Lots of different ways to value the market. And yesterday we had a discussion on the blog about the CAPE PE, which looks at a 10-year average of historical earnings and puts the market at over 23 times on a multiple, which sounds, greatly expensive. So here is a way that money managers think about the economy and think about stocks now that they've, a lot of global worries are off the table and they felt free. So here's my math. I say that PMs are buying forward estimates of $110 to $115 EPS for the next 4 quarters. That's from, going out from here, from June. And they're willing to pay a 16 times multiple. That means we could get to 1,800 next year. So within the next year, I see S&P 1,800. My year-end target is 1,750, which is still aggressive, but based on this math, that's how we get there. TD and BU, that stands for top-down and bottom-up models. When we talk about, somebody's got you hear a Wall Street strategist, guy from a big house, he says, oh, my target for the S&P is, 1,700, whatever. Well, that's his macro view. It's his top-down view of the S&P 500, and that's how he comes up. He puts a multiple on it and comes up with a price target. That's the top-down view. What's the bottom-up view? Well, that's just, that's created in the aggregate. You've got a lot of money managers who are out there just picking stocks, heads down, looking at earnings, looking at balance sheets, and saying, okay, what do I think this company is worth on some kind of discounted cash flow basis? What am I willing to pay for it today based on where I think it should be trading a year from now or something. So in the aggregate, you have PMs doing that on a bottom-up basis. That drives valuations higher as long as all these other conditions are intact. All right, last thing, the behavior is the one component that's hardest to measure. But, I say that, money managers have to buy stocks and they don't have to sell because they're in a performance game with each other and with the benchmark, the S&P 500. So they cannot afford to miss the greatest leg of a bull market that goes higher. And strength begets strength, and higher prices beget higher valuations. All right, so in a nutshell, yeah, there's a little bit of optimism in the market that needs to get wrung out. And, that's going to happen, probably picks up steam once we dip below S&P 1600, which is very likely up to the Fed. And we're going to hit a lot of stop losses. People who have a lot of profits on the table are going to take them off. But I'm definitely a buyer at 1,600 and 1,560. If conditions change, then we're going to rip through 1,550 and get our next buying opportunity at S&P 1,500. All right, I'm Kevin Cook. Thanks for joining me in the kitchen.